Well, good afternoon, everyone, and welcome to the Arrow EC Income Advantage webcast. My name is John Tedesco, and I'll be your host for today's call. On behalf of everyone at Arrow, thank you very much for joining us today. We always appreciate the opportunity. Our special guest speaker today is Mike MacBain of East Coast Asset Management. And during our time together, Mike will provide you with an overview and an update on the Income Advantage strategy. He'll share his thoughts on the latest developments within the fixed income landscape, and also talk about how incorporating alternative credit strategies can benefit fixed income portfolios. Of course, we will have some time left over for some Q&A at the end of the session as well. Now, we all know that the fixed income market was a challenging space to be invested in last year, and yet the Arrow EC Income Advantage Fund finished with a positive return of well over 2% net of fees. This in a year when many bond funds finished with negative single, if not negative double-digit returns. This year, Income Advantage has already delivered over 6%, and here we are mid-September with well over 3 months left in the year. And so Mike will not only walk us through how the team achieved the positive return that they did last year, but also how they're navigating today's current market environment. Mike is the founding partner and chief investment officer of East Coast Asset Management and has over 30 years of investment experience in the financial services industry. So with that, I'll thank everyone again for joining us today, and I'll now turn it over to Mike.
Thank you, John. I appreciate the introduction and the kudos to our performance last year. I'm going to run through a deck here. It's probably 10 slides, shouldn't take too long, just to go through kind of where we've been, where we think we are right now, what we think the opportunities are for the fund going forward. So first of all, just a quick introduction to our group. I'm the CEO. Sinan Agnes is the president or chief risk officer. Liam has been with us since he graduated from Waterloo. He's our head portfolio manager, and Leanne Jansen is our PhD and head of all research and credit analytics. So got a pretty strong team led by these 4 people up in this group on this slide. Key elements to our strategy and why you should be thinking about investing with us. So we're different from most other fixed income funds in that, we're looking to optimize the credit exposure you take. We're trying to position yourselves on the part of the credit curve that makes you the most amount of money for the risk that you're taking. So that sounds like an obvious motherhood and apple pie sort of statement, but it is actually a fact. There's a place to be positioned on the credit curve, and there's a place not to be positioned on the credit curve. We'll get into that in more detail later. We are giving access to a differentiated asset class. It's a distinct asset class in that we invest in the credit portion of investment grade bonds, and it's very hard to access that part of that asset class. We take very minimal exposure to interest rates. So one of the reasons that we've been able to outperform over the last 2 or 3 years is our performance has not been dragged down with interest rate losses from interest rates rising over the last couple of years. And lastly, the liquidity of our assets, our underlying portfolios, Canadian investment grade bonds, very liquid. And this fund has a mutual fund that's an ETF wrapper and daily liquidity. So liquidity is key for this product. So I want to talk a little bit about isolating credit spreads and how we remove the interest rate exposure embedded in the bonds that you buy. So the first thing I do is I go out and buy a corporate bond. In this example, it's a 5% yielding corporate bond. Let's assume that's an RBC bond. If I take the close off that bond, it has 2 risk and 2 return characteristics. The first is the Government of Canada yield for that maturity. And in this case, I've used 3% as an example or an illustration. And the second is the credit spread component. So that's the credit that RBC's got to pay me, or the credit yield that RBC or spread that RBC's got to pay me to convince me to buy their bond instead of just buying the Government of Canada bond. And in this example, that's 2%. So the way that we eliminate the interest rate exposure is I simply sell short that Government of Canada bond. So in this example, if the interest rate in that Government of Canada bond went from 3% to 4%, the yield of the corporate bond that I bought would go from 5% to 6%. I'd lose 100 basis points of the present value of 100 basis points on the corporate bond that I bought. I'd make the present value of about 100 basis points on the Government of Canada bond that I sold short. And interest rates have gone from 3 to 4%. Net, my fund has lost no money, and interest rates are higher by 100 basis points. So the exposure that I want and the sort of separate asset class or the access to the asset class that I'm interested in is that credit spread component. That is the far more certain cash flow stream that RBC and TD and BMO and Bank of Nova Scotia, the risk is that they don't pay me back. It's a far more certain revenue stream over a short period of time than is whether or not interest rates are going to be 1%, 2%, 3%, 4, 5, 6, or 10%. And so I've managed to bifurcate that risk exposure and choose the piece that I want. That piece is lower vol, more certain, and it's negative, and most importantly, it's negatively correlated to interest rates. The credit spread portion works inversely to the interest rate portion of that corporate bond. So in a market that we're in like today, and have been probably for the last decade with central banks intervening like they have, equities and interest rates have been very correlated. In fact, it's very hard to find an asset class that's not correlated to interest rates. And our product is not correlated to interest rates. So that's a key element to the strategy. This next slide really talks about optimization of that credit exposure and how we do it. So really what you need to think about is you can earn a return in two ways in fixed income. You can earn a coupon return or you can earn a capital gain. So the coupon return that you earn, obviously on this slide, you want to be the highest up on the chart in terms of yield. And so at the 10-year point where that orange circle is, that's a 10-year bond. It has the highest yield on this chart. At the 2-year point where that green circle is, that's at the steepest part of the credit curve, slightly lower nominal return, but the steep part of the credit curve gives you a significant capital gain as you roll down that credit curve. Okay, so that's really where you want to be positioned. So just in simple terms, you don't really want to have 10-year exposure because that's where the capital gain is the lowest. That's where you're getting the least efficiency out of your credit exposure. The 2-year nominal return is smaller, but the risk is 20 to 25% of the exposure of the risk exposure in the 10-year bond. So in this scenario, from a total yield standpoint, we can by using modest leverage in the liquid alt product, I can earn 200% yield for taking similar amounts of risk than I could earn if I just bought that 10-year bond. In terms of capital gain and roll down the credit curve, I'm earning, somewhere around 2 or 3 times as much capital gain as I roll down that credit curve. And from a credit duration standpoint, I'm taking my exposure at the 2-year point. 3 times levered portfolio still has me taking 75% of the return or 75% of the risk that I'd be taking if I own that 10-year bond. And so we can set up a dynamic here because of the way the liquid alt product works, where I can earn roughly 3 times as much money and take roughly 75% of the exposure of the person that's taking the 10-year bond by buying 2-year bonds at that sort of sweet spot on the credit curve. And so that's what we're doing. Here's a slide that just really kind of puts things into perspective about the return and where our return gets made, because we've been in a market for a long time where the cash returns have been pretty much zero. So we've always been telling people in this product that we're looking to earn 4 to 6% as an alpha generation strategy, kind of absolute return strategy using investment grade credit. And that's been true, and that's been what we've been doing for a long time. But now we're in a market where your money market yield is not 0 anymore. It's now 5%, and maybe even 6%. And so we earn that money market yield. As that money market yield increases, we earn that money market yield. And so now we're still earning that 4 to 6% return, but we're earning it on the base of a money market yield of 5%. So that's generating a very high single-digit return for us and a low double-digit return, which I think everybody would agree is an extremely compelling opportunity in the market today to be earning 9 to 11% out of an investment grade bond fund. So what's the current opportunity here? So this is a chart of 3-year senior bank credit spreads, so deposit notes effectively. And we use this as a good proxy for our portfolio because the average life of our portfolio is about 30 months. And the portfolio is probably, on average 50 or 60%, financial institutions in Canada. So if you look at this chart, you can see it goes back to 2010. And the spread on 3-year Canadian bank deposit notes has been somewhere between kind of high 40s to where it was in COVID for a couple of weeks, almost up to highs 250. So if I take that 2-week period in COVID out and kind of throw it away and say, okay, it's not impossible that can happen, but let's put that in as an outlier, you can kind of see pretty easily that the spread in terms of where credit trades is somewhere between high 40s to 150. And so obviously we want to be overexposed to the credit market when spreads are higher and underexposed when spreads are lower. And so you can see there in late 2022 where spreads peaked at about 150, that was in October. We were fully positioned at that point. As credit spreads narrowed in January, we took our exposure down to about 60% of what it was in October. And then the March kind of regional bank failures that took place in the end of March in 2023, that had spreads pushing right back out to those wides again. We got fully exposed again then. And now where spreads have come back into 100, we're still bullish on the market, but we think spreads have moved quite a long way and we've taken our exposure down about 30%. And so we're pretty active in moving that exposure around. I compare that to put a credit duration number on it. In October and March, our credit duration was about 12. And so what that means is sensitivity to credit yields moving higher. If you've got a credit duration of 12, if they move higher by 10 basis points, you're going to lose 10 times 12 or 120 basis points. If they move lower, you're going to make that 120 basis points. So in October and in the end of March, early April, we were running credit duration exposure of about 12. In January, we were running 8. And you see back towards the end of 2021, where credit spreads were down in the kind of low 50s, high 40s, our credit duration was 3 at that point. So we really move our exposure around a lot. And that's one of the reasons, if you see 2022 there, credit spreads widened from low 50s all the way up to kind of 150, 180, or 100, up to like 120 to 150. So that credit spread widening event in 2022, we sidestepped most of that because our credit exposure was so low at the end of 2021. And so it's a key differentiating factor in our funds is that we move our exposure around a lot. When you're not getting paid much for the exposure you're taking, we're not taking much exposure. When you're getting paid a lot for it, we're taking a lot of it. And so that's one of the reasons we've been able to outperform a lot of our competitors, and we'll get into that in a couple more slides. So this is just a chart of sort of monthly spread movement. Gives you an idea of what the volatility of spreads has been over a little bit less than a year. And so you look along the top, that's the change in credit spread. And you can see that, outside of 1 month in March, which was the regional bank failure month where credit spreads widened pretty materially that month. Whether spreads have been higher or spreads have been lower, we managed to produce a positive return month in and month out. And this is the kind of the low volatility asset class that I was talking about. If I plotted, an interest rate chart here and stuck in the government bond index or the Canadian corporate bond index, they wouldn't have had one red month up. They'd have had 50% of their months would have likely been red. And so again, if you're looking for kind of, statement calming investments, people are interested in seeing stuff that's continually generating positive returns. And that's generally what we get in our product. This is a slide, just discrete observations of the yield in the fund at the end of each quarter, going back to December 2021. And think important to get the context of this because 5.6% in March of 2022, that's roughly been, we've roughly had our average yield over, last 10 years has probably been in the low 5% range. Okay, so you can see that in December 2021, our yield was really low. Our yield was really low for the obvious reasons. We didn't have any positions like we just talked about. Our exposure was low. And the spread that you're getting on those positions was pretty low. So you combine those two elements, you don't have a lot of risk. You're not getting paid much for the risk you're taking. You're going to have a low yield. So in March of that year, credit spreads had widened quite a bit, if you remember this slide. So credit spreads started to widen quite a bit in sort of January, February. The Russian war started. There were a bunch of other stuff going on, so spreads were widening. And you can see that the yield on the portfolio in March, almost tripled. And then again in June, spreads started to widen again, and the yield, went up by 50%. And then again in September. And so in September, we were starting to get fully positioned. Okay, so that move from 7.6% up to 9.3% wasn't necessarily because of credit spread widening. That was more because we said, okay, now we're at the point where credit spreads have widened. You're getting paid to take this risk. We want to get involved and get positioned in the portfolio. And so that's why the yield went up to where it did. And then by December, that was kind of end of October was kind of the rise in credit spreads. So this fund probably touched 10% in terms of yield in October. And then you can see it's been pretty static around nine change, which for an investment grade bond strategy like this is, a phenomenal potential return. One other comment on credit spreads. So the other thing that having credit spreads at a relatively high level at your entry point into the fund is that, and the fact that you have a yield that's, almost double digits, those two items give you a lot of protection against potential negative movement in credit spread. So right now, credit spreads are at about 110, 115, probably 120 actually, given what's happened so far in September. Well, let's say they're 120 to make the math easy. So credit spreads at 120, the yield of 10%. My credit duration slightly less than 10, so it's probably 8 and change. You can withstand about 110 to 120 basis point widening in credit spreads before you lose money in a year over a 12-month period. So if you take that, you're looking like you're almost right around where credit spreads were during COVID. That could be the bad event that could happen in a 1-year period, and you're still not going to lose money. So that again, I think speaks to the defensiveness of the strategy. So I'm going to finish off just on a couple of performance points. Some people think we should put these at the start to get everybody's attention, but we're going to put them at the end. So as John said, 2022 returns for ourselves, we made a little over 2%. You can look at the rest of these bond funds and bond indices, XGB in dark gray, XCB, which is a corporate bond, investment grade bond ETF in light gray, and then Manulife, PIMCO, and PHNN. So all those firms and indices having negative performance and significantly negative performance. And then you look at performance year to date this year, 5.5% for us. PIMCO is the only one that's even anywhere near us, and the rest are roughly half. And in terms of the government index, even worse than that. And then on the right hand side, this is the 5-year index, our 5-year returns. Sorry, this is since June 2020 returns. 20.5% in green for us. The only one that's even half the way there since this fund's inception would be the PHNN High Yield Fund, which is a different kettle of fish. And you can see the performance of the other 3 or 4 funds and indices. So again, I think the performance speaks for itself. And this is against our peer group. RP, Debt Ops Fund, the Algonquin Strategies Fund and YTM's Credit Fund. Probably not a fair comparison because we're comparing a mutual fund product to OM products here, but again, our performance stacks up extremely well in 2022, extremely well in 2023, and since inception as well. Then the last thing I wanted to leave you guys with is this kind of diversification slide. So if you just look at adding a piece of our strategy to a 60-40 portfolio, what does it do for you? So if you're in your 60-40 portfolio, S&P TSX, and 40% the Canadian bond index, annualized return of 6%, vol of almost 10%, and a Sharpe ratio of 46. If you split your fixed income bucket, only using 20% of our product, you can increase your returns by 25% and reduce your volatility over that period. So that's a shockingly high number for just moving 20% of a portfolio to be able to move the return number by a third. So I think that's all I've got for the slide. Yeah, I don't think I need to go through this for everybody. That's probably enough. So I think we'll just end it there, John. I probably spoken long enough.
No, that's fine. And thank you for that, Mike. So what we'll do is we'll open it up to questions. And I'll start with one already is, Mike, what's your opinion on the number of rate hikes left from the BOC and the Fed?
I mean, it's data dependent, as they both said. I think for now we're on hold. So I think the Fed meeting this week, we're probably going to see that they don't do anything. But my view of the market overall is that we're going to see stronger inflation data, and we're going to see stronger employment data than the Fed and the Bank of Canada want. So wouldn't surprise me to see another rate hike from the Fed this year. I expect the Bank of Canada to be a little bit less aggressive than the Fed. So again, it depends on the data, but I'm certainly still in the camp of the probability of rates rising from here is higher than the probability of rates falling from here, in my opinion.
Thank you. Now, understandably, most of the portfolio is invested in Canada, but let's just take a look at between US and Canada. Which credit market looks more appealing at the moment?
Yeah, so today, the Canadian market has kind of been on vacation all summer, and it's been a rallying credit market. So what tends to happen in markets like that is the US market is still very much a global market, is transacting all the time, and US credit spreads have rallied a lot this summer. It's been a situation where people have been buying bonds. They haven't been able to get a 5 or 6% yield out of their bond portfolio for a long time. So there's been demand for product, but there's been no supply because of the summertime. And so credit spreads have tightened in a lot in the US. They've tightened in Canada, but probably at about 40% of the pace. So relatively speaking, Canada is definitely got more room to run than the US does.
Okay. Great, thank you. And that seems to be it for questions so far. And if there aren't any further questions, I'll just take a quick moment here to wrap things up. First of all, thank you, Michael, for being here. We really appreciate it. And thanks to everyone who joined us on the call today. We always appreciate the opportunity to be with you, so thank you for that. In summary, what we'd like you to take away from today is the fund is 100% short duration, high quality investment grade bonds. It has a gross yield of over 8.5%, providing a healthy NAV cushion should credit spreads temporarily widen. The fund has a low correlation to traditional fixed income, so it makes an excellent complement to any traditional funds you may have in your business already. The ROEC Income Advantage Fund has been a top performer in its class since 2016. It has daily liquidity and has a monthly distribution option that pays around 5%. And it's also available in an ETF. Ticker symbol RATE or RATE. So as a sales team, we feel that we have the luxury of representing the premier management team in this space today. And We would encourage you, if you're considering incorporating a new provider into your business, we strongly encourage you to look to Mike and his team's expertise. And if you're already a supporter of the fund, we thank you for that support and we thank you for your trust. Should you have any questions beyond our time here today, please don't hesitate to reach out to your Arrow representative. And with that, I'll thank you once again for joining us today and wish you all a great rest of the week.